All right, Pops, we have banks fleeing, literally ending their business with car dealers. They are no longer lending to car dealers to allow them to purchase cars and floor plan them, have them at their dealership on their dealer lots. This is fascinating. We've had two really large institutions, Capital One and Fifth Third Bank, just pull out, just say, hey, we are done lending to car dealers. This is super interesting.
Well, they're reevaluating where they want to put their money so that they can get the greatest return on their investment for their, stockholders. So at the moment, with floor plan utilization down because of inventories being lower than normal, a lot of these banks are looking at it and saying, well, we could be making a greater profit if we use that money for other things.
You're not right about that though, Dad. We know, we saw TD came out with their floor plan utilization has been growing higher and higher as inventory is sitting longer and longer. So I don't agree with that. Floor plan utilization is actually going up. It might be for fewer vehicles, but the amount of floor plan being used is up. That line of credit's being tapped more because those cars are sitting there longer.
It's going up from typically floor plan utilization used to run somewhere between 65 to 70% of what was available for dealerships. After or during the pandemic, that shrunk to about 25% because there was literally no inventory to floor plan. That number today is up to about 40%. So it's still below what it had been in the past, but it has gone up dramatically. And yes, you would think with inventory levels starting to build back up to some degree again, that it will continue to rise. But it will probably not get back to the same level of utilization that it had been pre-pandemic, which is why some of these banks are looking for other ways to utilize the money. Now, yes, for me, I could say, okay, the banks are just looking for a different way to make money. But it also signals to dealers that it's going to be a less competitive marketplace for finding floor plan availability at a less expensive rate because there's fewer players in the market. So that's the part that's scary.
All right, good news, Pops. We have another promotion.
Yep, Spring 20 and Spring 100. Get 20% off on our coaches and data, or get $100 off on an extended warranty. Spring ahead, everybody.
CarEdge.com. Take advantage. Thanks. Yeah, so and heck, we could do a whole video just talking about like that happening to banks in general in the United States, but we'll stick to dealers right now. Let's just explain like I'm five. ELI 5, Dad. Floor plan is essentially a line of credit. That's all it is. It's a product from a bank that's a line of credit, and you can use that line of credit to buy and then hold on to cars on your lot. Most car dealers do not pay cash for their inventory. Many of them use lines of credit called floor plans to hold on to that inventory. Now, every day that car is sitting there, you are paying more interest. Just like if you have a high interest savings account at your local bank that right now is yielding more than it did a couple of years ago. Yeah, you might get paid on that interest monthly when they send you that check or they put it into your checking account, but you're accruing interest daily. The same thing with a floor plan loan. And so you would think, Dad, pretty much any lending product right now would be very profitable because heck, Fed funds rates going up, interest rates are going up, but you see Capital One, you see Fifth Third pulling out of this, and I think you're spot on. It's because they are finding more profitable ways to make money elsewhere, less risky ways to make money as well. You've got to imagine in these organizations where they're looking at their portfolios and they're thinking to themselves, why would we write a floor plan line of credit on all these vehicles whose prices are fluctuating up and down and up and down and up and down. And the collateral is obviously the vehicle.
Yes.
And what do these floor plan companies do? If they have to do it, they'll have to actually take those vehicles to auction and liquidate them to try and get made whole. I don't blame Capital One or Fifth Third for leaving dealers in the dust. I wouldn't want to be holding on to a dealer's liability if they bought a super expensive used car that loses 10, 15, 20% of its value if this bubble eventually bursts. And I think those are the conversations they're having.
And the difference is when you're talking pre-owned cars, and there are a lot of independent pre-owned dealerships out there, yeah, that could really be the case. Now, on the new car side of things, at new car franchises, the depreciation doesn't even start until the vehicle gets sold. So it's a little safer on the new car side of things. It's a little riskier on the used car side of things. And truth be told, at new car dealerships, typically the floor plan is owned by the captive lender. Okay, for the new car side of things. Well, and it could be for new and used cars. But independent lots, they're the ones that are using Fifth Third Bank, Capital One, others. So yes, that's a riskier investment because the value of those used cars has proven to be somewhat volatile over the past 3 years.
Yeah, absolutely. And also, let's just make a corollary here. Auto loan delinquency rates, I'm talking about consumer auto loan delinquency rates, are spiking up.
Yes.
I don't have a great data source. If someone out there has a great data source for commercial floor plan delinquencies, please inform me about this. But from the folks I've talked to, Dad, I've heard myriad stories of cars showing up at auction because whoever was doing the floor plan, it could have been a local credit union, could have been Capital One, could have been Chase.
Yes.
They're sending vehicles to auction because dealers are not making payments on them and they're getting out of the business. There was a huge spike in new independent car dealers during the pandemic because it was an incredible profit center.
Yes.
Anyone could make money. We had consumers flipping cars. We had myriad stories. People used to call into our call-in show talking about how they could buy a new car in Southern California, take it to the dealer auction and sell it for more at the auction. So we had people doing crazy stuff. Those folks likely overextended themselves. Now the market, as the folks from Capital One said in the article from Auto Finance News, there's challenging times, headwinds in the market.
Yes.
Now you're seeing some liquidation happening. And one company I'm keeping my eyes on in particular, Dad, Ally. Ally has a ton of floor plan out there. And with one company in particular, Carvana, we get Carvana earnings at the beginning of May. I am going to be watching closely what happens at Ally because they have a ton of exposure in the floor plan industry or the floor plan line of business. And I'll be very curious to see what happens there. If their earnings go up, their earnings go down, and what their loan loss provisions are for floor plan costs as well.
Anybody with a brain has to be excited to see what Carvana's earnings are going to look like, and how that impacts lenders out there as well. It is a tricky time to be in the automobile business if you cannot just pay cash for your inventory, and most dealers, especially independent used car dealers, and most new car dealers cannot. So yes, the whole thing is based on these established lines of credit, and if there's less competition because there's less players in the field, there's going to be higher costs associated with that.